Hey everyone, Coach Investor back to another video for today and the first dividend video of 2024. So with the probable rate cuts in 2024, a lot of investors will start to move their money from their savings account, from maybe growth stocks as well, into dividend paying ones with a good yield and a growing yield. That's the most important part because sometimes we look at dividend paying companies with a yield of 1 to 2%. And some investors are like, that's not good enough. But you have to look at how much that yield has grown in the past and how much that yield could grow in the future. You have to look at the cost on yields. Now in this video, we're going to have a look at 3 companies that are paying quite a good yield, in my opinion, for 5%, which I think is pretty good, especially for long-term dividend investors. So company number 1 is a company that has seen its stock beaten down quite a lot in 2023, and that's one of the biggest pharmaceutical companies in the world, Bristol Myers Squibb. Now in 2023, the stock was down 24% or so. It has a market cap of $107.3 billion. The first day of the market open in 2024, this stock was actually up 2.83%. Actually, stocks in the healthcare sector have actually started the year much better than the rest. And if you look at a lot of analysts, the sentiment towards healthcare stocks is much more positive for 2024 than for 2023. And this is also why the second stock in this video will also be in the healthcare sector. I'll talk maybe about the healthcare sector as a whole in a different video. Let me know if you're interested in that in the comments below. As you can see, with regards to valuation, much cheaper than the 5-year mean. If you look at forward PE, it's now at 7 times compared to 9.2 times. By the way, it pays a 4.55% dividend yield. EV to EBITDA 7.7 times, price to sales 2.3 times, and then price to free cash flow 9.2 times. Now, the reason why we're seeing this big drop here, one, because the stock has gone down. But why has the stock gone down? Well, because of generic competing products that have hurt their sales by quite a lot. Now, if we look at shares outstanding, free cash flow per share, and the 5-year growth rate with regards to EPS, yes, here there was an acquisition of another company, so you see shares outstanding go up, but that has also increased their revenue and made their product portfolio bigger as well. But since then, they've been acquiring more shares. Free cash flow per share throughout the years have gone up. The current estimates for EPS in the 5-year growth rates here is basically flat. If we look at what the analysts are expecting with regards to the price targets in the next 12 months, the average sits at $61.9, which represents 17.36% upside. If we look at the dividends, so the 10 years annualized growth, 5%, in the last 5 years, 7.3%, and then even shorter than that, 5% 1 year and 8.2% 3 years. So basically, if you bought 10 years ago, you would have gotten 36 cents. You're now getting 57 cents. So definitely a strong dividend play. Now let's have a look at their latest earnings report. Revenue came in at $11 billion for Q3. That's down 2% year over year. But here you can see inline products are up 3% and new product portfolios are up 68%. Then with regards to the new product portfolio performance, they're building some strong momentum here. As you can clearly see year to date from 2021 to 2023, they went from $730 million to $2.5 billion. With regards to Q3 2022 to Q3 2023, 67% growth. Then with regards to the more long-term, they say here midterm guidance, so they reaffirmed low to mid single digits revenue CAGR from 2020 to 2025, reaffirmed low double-digit revenue CAGR ex revenue POM from 2020 to 2025, reaffirmed $8 to $10 billion in growth from inline brands, same period, and then adjust to over $10 billion in revenue from new product portfolio in 2026, and adjust operating margin target to 37% through 2025. So definitely promising midterm future. Then if we go and look at the chart right here on the weekly, we could say that the stock has bottomed at around $47, $48, which was also the bottom back in March 2020. So yeah, definitely a roller coaster ride. Right now we're sitting just above the 50-day moving average. The 21 sits at $51. The 200-day moving average sits closer to $60. RSI is still pretty low. We were oversold back just under $50. So if you're looking for one of those strong free cash flow generating, nice dividend paying companies, I think Bristol Myers should definitely be on your list. Now, before jumping into company number 2, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. The goal for 2024 is to reach 40,000 subscribers. I think we can achieve that, so I really appreciate your support. If you want to support me even further, do check out the link down in the description and the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, as I said, company number 2 is also in the healthcare space because it was hit quite hard in 2023 for the right reason, and that's Pfizer. Now, Pfizer in 2023 is down close to 40%, has a forward PE of 19.9 times, market cap $167.87 billion, with a dividend yield of 5.65%. Now, of course, if you look at the metrics here, you might say, but Couch, this is extremely expensive right now, right? It's more expensive than a 5-year mean. Yes, price to sales is a bit lower, but all the rest is definitely higher than the mean. Yes, I agree 100%, and that's mainly because 2023 has been a horrible year for them. Remember, previously, business was booming thanks to vaccines, pandemic, stuff like that. Business was booming, and the inevitable happened. Year-over-year comparisons, the business was hit, so you saw a huge decrease in profits and revenue. But moving forward, this is not a dying company, not at all. Moving forward, they are expected to do again much better. The current average analyst price target sits at $33, which represents 11.1% upside. If we look at the dividend here, they have an annualized growth in the last 10 years of 5.66%, but more recently, the last 3 years, for example, 2.81%. But here again, if you bought 10 years ago, you would be getting 26 cents. Now you're getting 41 cents. Now here I want to show you what the analysts are expecting for fiscal year 24 and 25, which might explain why this is on the list despite having a 19.9 times forward PE. So if you look at the fiscal year 2024 analyst estimates for EPS, they expect 48.18% year-over-year growth. And then in fiscal year 2025, another 23.68% year-over-year growth. So basically what you're paying right now is close to 10 times the 2025 PE. And for a company that is growing its bottom line so fast, in my opinion, is not such a premium, especially with that 5.65% yield you're getting right now. Yes, sales here in fiscal year 2024 just expected to grow 1.81%, but after that, reacceleration 5.85%. When you're buying this company, it's important to look at what they have in their pipeline. And so if you look at their Q3 earnings, revenue dropped 41%, while adjusted cost of sales increased 44% to $8.9 billion. They say here that was primarily driven by a non-cash charge of $5.6 billion for inventory write-off and other charges, $4.7 billion for Paxlovid, and $0.9 billion for a name I can't really pronounce here. The same here for diluted loss per share, loss of 42 cents, adjusted loss of 17 cents. Here again, they talk about a non-cash charge related to write-offs, in this case of COVID-related inventories. So again, this is the lapping of a strong COVID year. This was bound to happen. If we look at their guidance, so revenue for the year between $58 and $61 billion, a decline of between 41 and 38%. With regards to adjusted diluted earnings per share, $1.45 to $1.65. Operational decline versus prior year, 75 to 72%. But again, it's all about what you're buying right now to what you're going to get in the future. So in this slide, they show us excellent progress towards expected commercial launches. On one side, around $20 billion of potential revenue expected for new molecular entity and new indications by 2030. On the other side, around $25 billion of potential revenue expected from new BD deals by 2030. BD meaning business development. And here as well, pretty similar to Bristol Myers. If we look at the graph on the weekly, you could say that it bottomed at around the same price it bottomed back in March of 2020. Then we had that huge pandemic momentum. But since then, since December 2021, the stock has gone down. Currently, we are sitting at the 50-day moving average, which is right under the $30 mark. 200-day moving average sits at 34.88 cents. The 21 at 28.6 cents. RSI pretty low. And yes, back when we were under $26, the stock was oversold. So here again, you're getting a pretty strong dividend paying company with a pretty strong product portfolio for the future as well. So you know that this company will continue to generate cash from operations, free cash flow as well, which will pay you that dividend, will enable them to pay you a dividend and in the future buy back more shares as well. So yes, two companies in the same sector, but I do believe that that sector was beaten down so much that you can find some bargains there. Then company number 3 is a company that has nothing to do with healthcare, is a company that has to do with aerospace and defense, and that's Lockheed Martin. So Lockheed Martin currently has a market cap of $113.16 billion, forward PE of 17.3 times, dividend yield 2.76%. Yes, the stock right now, if you look at the forward PE, forward EV to EBITDA, and even price to sales a little bit, it is more expensive than the 5-year mean. But if you intend on holding this stock for years and years and years, you know that you're getting a lot of value, not just because of the dividend yield, but because of the companies buying back their own shares. Free cash flow per share keeps increasing as well, and the forward growth rates for EPS sits at just under 9%. If we have a look at the analyst price targets, the average sits at $482.3, representing 5.75% upside. And if we look at the dividend, the 10-year annualized growth sits at 10%, more closer to us right now, 3 years, 7.72%. So here again, if you bought 10 years ago, you got $1.33. Right now you're getting $3.15. Having a quick look at their latest earnings report, sales of $16.9 billion, $1.8 billion segment operating profit, 10.7% segment operating margin, earnings per share of $6.73, 0.9 times book-to-bill ratio, free cash flow $2.5 billion delivered, $1.8 billion share repurchases, and $0.7 billion in dividends. And more importantly, here is the backlog that has increased year over year, sits now at $156 billion. I repeat, a backlog of $156 billion, $55.2 billion in aeronautics, $33 billion in missiles and fire control, $37.5 billion in rotary and mission systems, and $30 billion in space. Now, if we look at the graph, of course, much more different than the healthcare companies we've seen before. This company, this stock, has gone up in the last 2 years. We can also see that it made higher lows in the last 2 years as well. Right now, we are sitting above all the moving averages here, 20, 50, and 200. For interest, the 200 sits at $447.2. RSI still pretty neutral at 55.5. Yes, unfortunately, this company makes money when there are geopolitical issues around the globe. So there you have it, 3 strong dividend-paying companies. You will see that when interest rates will come down, dividend-paying companies will be back in favor. Even before rates come down, because the markets are always forward-looking, you will see that suddenly more and more investors will try and find good deals, dividend-paying stocks that have a high yield where they can put their money in and sleep well at night. I think the healthcare sector, some of them will definitely benefit from that. Of course, do share your thoughts and your picks down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.